everybody, and welcome to today's live webinar. Thanks a lot for taking the time and tuning in to our program. I will be your host, Simon Duhame, and as always, I'm very happy to be here with you. And we're in great company today. And if you're like many investors, chances are you've seen and you've heard plenty about cryptocurrencies and digital assets as of late. As there has been a surge in interest among investors to get involved in one way or another with this emerging asset class over the past few years. In fact, the total market value for digital assets was estimated to be worth more than $2 trillion as of October 2021. This is according to researchers at the Bank of America. And of course, this is a number that tends to fluctuate with so much volatility in this space. Now, what many investors might not know, though, is that cryptocurrencies and digital assets are just one part of an emerging trend that we see in internet technologies, and it's known as Web3. Some industry watchers really believe that this can completely transform the way that we interact online in the years ahead. So, we wanted to help get our audience a clearer picture of the risks and opportunities that Web3 may present in the future. And hopefully help you make some informed investing decisions in what seems to be a highly speculative space. For a closer look, we turn to Alex Tapscott, a managing director of Ninepoint Digital Asset Group. He's a globally recognized writer, speaker, and investor on cryptocurrencies, blockchain, and digital assets. Alex and his father, Don, co authored the best selling book, Blockchain Revolution: How the Technology Behind Bitcoin and Other Cryptocurrencies is Changing the World. The pair also co founded the Blockchain Research Institute, a think tank investigating blockchain use cases and opportunities. Alex is going to share his perspective on digital assets as an investment theme for investors like ourselves to consider. And specifically, we'll be talking about the risks and the opportunities stemming from the development of the internet known as Web3. So, Alex, thanks so much for taking the time. Really looking forward to our discussion today.
Well, thanks for having me, Simon. I'm delighted to be here.
It goes without saying, Alex, you were one of the early voices when it came to Web3 and digital assets as a legitimate investment theme. So I'm super interested to ask you, like, what was some of the early reception that you received on some of these concepts, perhaps among your colleagues in the financial industry, let's say? What were their thoughts like?
Yeah, well, I started my career on Bay Street in Toronto working for the investment bank Canaccord Genuity. It was my first job out of undergrad, and I was there working in a variety of roles, but mainly in an institutional equity sales role. So I was, quite connected to the markets and was enjoying myself. And it was actually while I was there that I first learned about Bitcoin. Now, this was before the words blockchain or Web3 or any of these other concepts really entered the language, the vernacular. There was this one single thing. The more I looked at it, the more convinced I became that this was more than just some speculative asset that people were buying and selling and maybe using to do transactions online, that this was maybe a big technology innovation, that Bitcoin really had finally solved a really important problem with the internet, which is this concept called the double spend problem, which basically says, like, how do you ensure that when you move something of value online, that you can't send a version to someone else. And it solves this problem by employing this thing called a blockchain. Now, without getting into the specifics, the basic insight I had was, well, if this can make Bitcoin possible, something, a way to move Bitcoin peer to peer, maybe it could work for other assets. And since I was working in a market role, I was really kind of tuned into different kinds of marketplaces. Anyway, to make a long story short, I quit my job to take on a new project, which was to write a book with my dad, having never written a book and with no idea what was going to come after. But as they say, when you're offered a seat on a rocket ship, you don't ask which seat, you just hop on. And it's been quite a ride. But I will say, at the time when I told my colleagues at Canaccord that I was leaving to do this, they thought I was kind of nuts.
Looking forward to getting this conversation started. But before we go any further, here is a quick trivia question for our audience. It goes as follows. Digital currencies and tokens are one of the digital assets that play a key role in the Web3 ecosystem. The question is, what was the world's earliest known attempt at creating a digital currency? So stick around until the end of our interview where we reveal the answer. Let's get started. So Web3. This is sometimes referred to as the next evolution of the internet, but before it came Web 1 and Web 2, which we still largely operate in today. So, can you give us a brief walkthrough of what some of these earlier stages look like?
Yeah, absolutely. Web 1 is best thought of as the read web, READ, read web. And basically, what that means is that it was a medium for presenting information. So when you logged on to the internet in the early 1990s, which I'm old enough to remember doing, you would be able to read lots of information. You could access information, but you couldn't really interact with it. It wasn't really a communication tool. There wasn't a lot of rich media. It was much more of a static thing. But even at the time, that was a really big innovation. You can think of the read web, the first era of the web, as the web that democratized access to information. The second era of the web is known as Web 2, and that is the read write web. Basically, the web is not only something where we go to read information and access information, but it's a tool that we can write to, right? We can publish our own information. We can blog, we can tweet, we can post on LinkedIn, we can form communities on social media platforms like Facebook and others. And really, what Web 2 did was kind of democratize access to publishing, right? So all of a sudden, anybody anywhere could have a voice and could make their opinion heard. And that, as a result, had a really profound impact on media and publishing industries. But what ended up happening in Web 2 was that a lot of the communities and a lot of the value that was created from individuals coming together and creating social networks and creating these new tools was captured asymmetrically by large platforms, specifically big social media companies, digital conglomerates, and even financial intermediaries, because as those social networks formed, there was more and more transaction volume, and credit card companies, payment processors, and banks ended up capturing a lot of the value. So that's been the status quo basically for the last 15 years. You can think of the read-write web, Web 2, as kind of beginning right around the time that Facebook was invented in 2004. And now we're on the brink of this new era, Web 3. Web 3 is commonly thought of, or should be thought of, as the read-write-own web. And so basically what that means is if the first era of the internet democratized access to information, and the second era of the internet democratized access to publishing, to making your voice heard, then the third era of the internet democratized access to ownership of assets and identities online. So now individuals who exist on the internet can actually buy and sell, own, move, trade, all manner of assets, and not just cryptocurrencies like Bitcoin, but financial assets like stocks and bonds, titles and deeds, individual digital assets in in-game environments, art collectibles, intellectual property, even votes in an election. And all of that is made possible because of the innovation of blockchains.
Blockchain technology is really what makes this whole Web3 experience possible in the first place. So, can you unpack this for us in a little bit more detail? How does it work?
The idea of blockchain is that a blockchain is a ledger. A ledger is a record of transactions. Now, normally, ledgers exist inside of single institutions like banks and governments. What makes a blockchain different is that it's distributed across all the different computers that are connected into the network. So anybody can see what is in the ledger. They can see who sent what asset to whom, who owes what asset to someone else, and so on and so forth. They can see the state of the network at any point in time. But even though everybody can access and see it, no single entity can alter what's inside the blockchain. In order for the blockchain to be updated, it needs to, every node in the network, so everyone connected to it, basically needs to reach consensus on whether transactions that have recently occurred are legitimate. Once they have been approved, then they get added to that record. So basically what a blockchain becomes is an immutable record of transactions in a network. Now, the first blockchain was the Bitcoin blockchain. It basically validated transactions in Bitcoin. And so I think a lot of people conflate the idea of blockchains and Bitcoin. But really, you should think about Bitcoin as the first killer app for blockchain, in the same way that email was the first killer app for the internet, right? But fundamental to all of these digital assets is this concept of a blockchain.
Right. Yeah, that makes sense. And to build onto this theme, Alex, what role do you think that cryptocurrencies and digital tokens play in this Web3 environment that you're describing here?
So the first and most obvious kind of digital asset is a cryptocurrency. A cryptocurrency is designed to be a medium of exchange, a store of value, and a unit of account. Bitcoin is the biggest and by far the most dominant example of a cryptocurrency. There are lots of other different kinds of digital assets. Really, anything where you can imagine applying scarcity in digital assets to any kind of asset is an example where these kinds of things can be really useful. So, what are some other things that require scarcity in order to be valuable? Well, securities, stocks and bonds. Fundamentally, all a stock or a bond is a record of an asset, what that asset is, and what price it was purchased at. And those kinds of transactions can be captured on blockchains as well. So these securities tokens are one example of blockchain innovation being applied to assets. Another one are NFTs. NFT stands for non-fungible token. So just a bit of background there. If you think about a dollar bill, it's what's considered a fungible asset. I'm speaking sort of an American, concept, a dollar bill, or let's say a share of Apple or a Bitcoin. You can trade one Bitcoin for another Bitcoin, or one share of Apple for another share of Apple, $1 for another dollar. It doesn't really make a difference. These things are interchangeable. But when it comes to certain unique assets, like say art or collectibles, actually there's a big difference. You can't trade the Mona Lisa for some other rare piece of art because it's a one of one, right? So there are many assets in the economy where having scarcity, and not only scarcity in terms of the total number issued, but in terms of the individual asset, is super duper important. NFTs are now being used primarily for art and collectibles, these kinds of use cases where that type of scarcity is important. But I think soon NFTs will be used as the basis for creating digital identities for Web3. Because it's true that, lots of pieces of artwork are unique, but another thing that's unique is your identity, who you are. So every instance of you online can be basically tokenized as an NFT and become part of your digital identity. So you can think of using that digital identity as a way to open a bank account potentially in the future, as a way to access services online without having to share your information, because there are proofs of what is contained in that identity in the NFT itself. Other examples of really interesting digital asset innovation are stable coins. So people may have heard of stable coins. A stable coin is a digital asset that is pegged to some asset in the real world. It's typically the US dollar. And they're basically a way for people to get access to US dollar savings account, a way to move and store money in dollars, where they might not otherwise be able to do that if they're in, say, the Philippines or in India or other parts of the world where getting access to dollars is very difficult. So the key concept here that I'd like to get across is that any kind of asset, any kind of thing that requires scarcity can be digitized and put on a blockchain.
All right. Well, hopefully now that we understand the infrastructure of Web3 a little bit better, can you walk us through now how Web3 aims to improve upon the earlier iterations of the internet that we were just talking about, the Web 1s of the world, the Web 2s, and their shortcomings? How can Web3 come in here and improve this?
Yeah, well, I think what Web3 helps to solve is sort of one of the original sins of the internet, which was that there was no value transfer layer to the internet. What's really important about that concept of a value layer is that without having a way to move assets and money using the internet as a digitally native medium, we had to rely on intermediaries. Now, this might be confusing to some because you might think, well, I use PayPal online and I use my Visa, I put my Visa card into my Amazon account and I've got Shop Pay. So isn't that using money on the internet? Well, not really, because still what you're fundamentally relying on is an intermediary. And as I've mentioned, the intermediaries of the sort of internet age are sometimes the same as the intermediaries in the past, like banks, but now increasingly include big platforms and social media companies. And that's problematic for a few different reasons. The first reason is that they add cost and friction to transactions online. So it can cost upwards of 10% to move money, even when you're using online apps, between people on different parts of the world. The second big issue is that they exclude big parts of the population, especially when it comes to financial applications, because you need a way to prove your identity. And without having access to passport, driver's license, which many people in the world don't have, you can't prove who you are. And that means you can't get access to financial services. A third big issue is that they capture data. They capture data about people's use of their applications online. And that's problematic for a couple of reasons. The first is that it means we can't monetize that data. That data we know is worth something. The market value of the biggest companies in the world are largely made up of big tech companies, and it's in the trillions of dollars, and it's built on user data largely. But we don't own that data. It's owned by those companies. And then the second issue with that is that it can end up in the wrong hands, right? Because the virtual you isn't owned by you. It's owned by, the dozens of companies you interact with online. That information can be sold and repurposed for reasons that might not make you totally comfortable. So this idea of you not actually owning, you don't actually own your data, you don't actually own your assets online. They're owned by companies who can change the terms of service, who can repurpose your information, who can sell it to someone else. That's a problem, I think, that deserves an honest critique and maybe a solution. And I think Web3 provides a way for to solve those kinds of issues. So the area where this is having, I think, the greatest impact right away is actually in financial services. And there's this area of the digital asset Web3 world known as decentralized finance, or DeFi. So if Bitcoin was trying to recreate how we move and store money peer to peer, then DeFi is reimagining every function of the financial services industry, from lending to trading to how we manage risk, and much else, in a fully peer to peer way, where you don't need to interact with a bank or other intermediary in order to access financial services. In a couple short years, the value of assets in the DeFi world has grown to over $100 billion. And there are millions of people who are interacting with it every single day. And that's really significant because there are lots of people in the world who can't access financial services, who don't have a way to store and save money, who can't trade, and who can now do so via these digitally native tools.
Yeah, it's really interesting to think about. And it's kind of, as you said, this could present some brand new business models outright for certain companies or certain niches. And even if it's sometimes just eliminating the middleman altogether. So, just like anything, though, there's pros and there's cons. So, there must be some potential challenges or at least some shortcomings that come into play with Web3 to consider. So, can you share some of these for us?
There are lots of different kinds of challenges to making Web3 a reality. Are the technology tools that I'm describing, things like blockchains, are they ready for prime time? Can they actually handle the kinds of transaction throughput or business use cases that we're describing? Will users be able to interact with these technologies in an easy and simple way, or do they have to be technically literate? And does that create all sorts of barriers, to adoption and barriers to entry? Will incumbents, big companies that have a vested interest to protect, whether they're banks or big technology companies, try to stifle the growth or maybe co-opt the tools? How will governments react to it? Every time there's a new technology innovation, it's often met not only by leaders of the old paradigm, but also by people in government with a certain skepticism. And I think, frankly, skepticism is healthy. And the fact is, a lot of new innovative companies and projects are building applications that allow people to move assets, store assets, buy and sell, trade, all these kinds of things. And that puts them into the realm of financial services. And once you're in the realm of financial services, you're in a way more heavily regulated industry, rightfully so. When you're dealing with people's assets, there are going to be more rules and restrictions than there are when you're dealing with people's with information. So the way in which this technology changes existing business models is going to put them on a collision course, not only with incumbent institutions, but also with regulators. And that's really an important thing to understand. But it's also equally important that we understand that any applications that deal with assets can also attract scammers and frauds and other kinds of undesirable people. And it's important that we balance the priority of encouraging innovation and enabling Web3 with the objective of ensuring that these tools are not used by criminals to do bad things. And I think that's something that has to be addressed. It's important to put that front and center when you're talking about any new technology. So these are all issues, right? Things that must be addressed. So you have to ask yourself, are these reasons why Web3 and blockchains are a bad idea? This idea that maybe we won't be able to scale the tech. Maybe we can't make it user friendly. Maybe criminals will use it, and perhaps that's just too much to bear. You have to ask yourself, are these reasons that it's a bad idea, or are they implementation challenges to overcome? And in my opinion, looking at every single one of those different things, they're an implementation challenge to overcome. In 1994, 1995, there were a lot of people who thought about concepts like video streaming, who talked about other kinds of models of companies that weren't really possible at the time. Like in '93, the commercial web was not advanced enough to handle Netflix or to handle Uber or to handle the cloud or any of these other kind of core technologies and products that we use every single day without really thinking about it. That didn't mean that those things were a bad idea. It just meant the technology needed time to scale. So in my opinion, a lot of the tools and technology systems that blockchains enable are in a rapid process of becoming better. And that's something that is already clearly evident from the growth of Web3, from a starting point of just Bitcoin, right? It was just Bitcoin, and now there's this whole world.
Okay, so at this point, we've heard some of the potential advantages and disadvantages of Web3. So let's talk business. Let's talk investing. What's the investment angle here in your view?
A lot of the value is actually created at the digital asset level. So, for example, Bitcoin is the dominant cryptocurrency. It's sort of the final settlement layer for the Web3 economy, and that's why it's worth almost $500 billion in size. There are other kinds of ways to get exposure to this asset class. In the digital asset world, Ethereum is one that probably a lot of people have heard about. Ethereum is different than Bitcoin. I think people think, is Bitcoin and Ethereum, are they the same thing? Are they competing? And they're actually quite different. So if Bitcoin is designed to be money for the internet, Ethereum is a platform that allows you to build and run applications. And that's because it's programmable. And without getting into too much detail, you can kind of think of Ethereum as like the Apple App Store, iOS, the operating system. So the more applications that get built and launched inside of the Apple App Store, the more valuable the Apple App Store becomes. And with Ethereum, most of the Web3 applications that are getting built in areas like DeFi, so those lending apps and trading apps or NFTs or stable coins are getting actually built on top of Ethereum. And then once you get beyond sort of the big crypto assets, either the big currency like Bitcoin or a big platform like Ethereum, you're really kind of just picking stocks. Like you're picking random names. In the same way that someone might say, hey, I've got a stock that I own that maybe you should take a look at. It's some small cap stock. That's kind of what a lot of cryptocurrencies are like. It might work out, but it might not, right? Like any other investment in a small cap company. And so in general, I would advise caution to anyone who's looking at individual crypto assets, simply because like any early stage venture, there's a high chance of failure and obviously a high degree of risk, right? And so that's something that investors need to understand really well before jumping into this market.
What are some of the potential ways that investors can consider gaining direct exposure to Web3?
Investing directly into crypto assets can be really tricky. And that's because, you might have to open an account with a company you're not familiar with, send the money, buy those assets. And then after that, you've got to know how to, secure those assets, store them safely for the long term. And all of that creates barriers for investors. And I think that's why investors are still generally investors are generally underinvested into the world of Web3. So that's why companies like ours, Ninepoint, have created basically on ramps for people to gain exposure to these assets in safe, convenient, low fee, and very familiar formats, right? So we have a publicly listed Bitcoin ETF that trades on the Toronto Stock Exchange. Incidentally, it's also carbon neutral. We offset 100% of the footprint of our Bitcoin that we own. Bitcoin, like any other industry, uses energy to keep itself secure and to keep itself working. And we want to make sure that investors have a way to gain carbon neutral exposure to Bitcoin. There are other examples of funds that offer similar kinds of exposure. And there are similarly funds that offer exposure to baskets of equities, of companies that are exposed to this asset class and to this new industry in some manner. I think it's also worth pointing out that investors should try and look at ways in which Web3 will disrupt existing companies. Maybe there are certain existing firms that are doing a really good job of embracing Web3 tools. One example would be Block, formerly called Square, a payment processing company. You may have seen their little dongles on top of phones at merchants and things like that. They're doing more than most companies to integrate Bitcoin into their business model. PayPal is another one. MasterCard, Visa, these are companies that are payments giants that have invested in and are built digital payment technology, digital financial tools. And so naturally, they're quite in tune and quite adept at understanding these things as well. So it's not just small cap companies and digital assets. There are lots of other big businesses that are also integrating some of these tools. Some of them, I think, as I mentioned earlier, are trying to present themselves as being open-minded to Web3 concepts. One would be Facebook. So they've renamed themselves to Meta because they want to build a metaverse. Now, without going down a rabbit hole, it's just important to understand what this is. So the metaverse basically describes an immersive online environment where individuals can move freely between different environments, take their assets with them, maintain their digital identity, and basically exist online as they do offline. What Facebook would like to do is to basically create, instead of the metaverse, like the internet, they want to create a metaverse, a Facebook metaverse, a walled garden where you are subject to their rules, their terms of service, and where they take an enormous cut on any transactions that happen inside of that environment. So Facebook is calling themselves Meta, but really what they're doing is they're trying to replicate a Web2 model just in a virtual world, right? And so I think it's important to understand when you're looking at how big companies, existing companies, are trying to integrate or understand these tools, that some of them might be doing so not because they're embracing these concepts, but actually because they're trying to defend the status quo. And I think in Facebook's case, that's exactly what we're seeing.
Interesting. So, how might an investor do this then? I'm talking gaining exposure to Web3 without holding some of those higher risk assets like cryptocurrencies directly, maybe more of an indirect approach.
Well, I think it's important to understand that, like any new industry, this is mostly considered like venture cap. And I think it's like any venture cap investment, you don't want to be betting the farm on this. And I actually think that investing directly into well-established, crypto assets that have a proven product market fit and are widely held and are growing in utility and value is a good place to start. There are funds that offer investors a portfolio approach to companies that are exposed to Web3. And I think over time, there will be more and more examples of that as there are become more and more companies that are publicly listed that actually offer that kind of exposure. If you tried to do this, 3 years ago and put together a portfolio of public stocks that were exposed to Web3, you would have had pretty slim pickings. Like it would have been a choice of a handful of relatively small cap companies. There are big corporations that I think are integrating this technology in a really meaningful way, and so you can actually start to think about building a portfolio approach of high quality businesses.
Now, some of our audience might be wondering how they could find Web3 investment opportunities to research further. And Alex, you mentioned that diversified investments may reduce risk in what could be seen as a highly speculative space. So let's take a dive now into Web Broker to demonstrate how to screen for funds that invest in digital assets.
An attempt to save you some time and perhaps show you one of the tools available to help us get there, why not click on the research tab here of Web Broker? First question will be, which type of investment are we looking for? And if we're talking about a mutual fund or ETF, it will be one of these two. So let's go ahead and click on an ETF as an example for today. From here, of course, you'd be able to see all kinds of different categories, all kinds of different types of ETFs, allocations. But what I wanted to point your attention towards was at the bottom right corner of the page where you will see the ETF quick screen tool. And from here, you'll be able to enter to the system what you are interested in finding out on there on the market. Because if you didn't know, there are hundreds of ETFs, if not thousands. How do we get the ones that match that criteria that we're searching for? And one of the ones we can, of course, use would be the ETF category screen. From here, you'd be able to see all kinds of different ETFs, both in the Canadian markets or the US markets. But to kind of follow the theme of what we were talking about today, there is one that exists on digital assets. And from here, as you can see, there will be 38 matches that match that criteria. So if we were to view these matches, we would be able to see all the ETFs that are involved in one way or another to either the Web3 environment or the crypto currency environment in one way or another. You would be able to do a little bit more of a deep dive by focusing on one of these funds. But another tool that would be worth talking about would be, let's say that there's a couple of these or a few of these that pique your interest. For example, maybe you're interested in the GBTC, maybe you're interested with the Bitwise Crypto Industry Innovators ETF, and let's add one more for the sake of it. Let's say we are interested also in this one from First Trust Skybridge Cryptocurrency and crypto industry rather, and digital economy ETF. Let's say you are looking for a little bit more information here. You'd be able to compare any of these funds by just clicking the little check mark icon next to them and clicking the compare at the top. From here, we'll be able to see each of the funds side by side to compare on some of the important metrics that you might be interested in, such as the risk profile, such as the performance profile, or any other fundamental information that you are searching for. MER would be one of those as the management expense ratio. So just a couple tools to help you in your search.
Okay, hopefully that demo gives our audience one way to start their research into this space. Unfortunately, we're going to have to leave our conversation there, Alex, for the sake of time. It was a pleasure to have this discussion with you, and we have so many more questions, and we will get to those. Thanks so much for taking the time to clarify what Web3 is all about. And of course, this is just an introduction to the investment theme, and investors may want to do further research to learn more and to understand risks and opportunities that perhaps we didn't cover today. With that in mind, we're not going anywhere. We're going to move on now to our live audience Q&A shortly. So any questions, thoughts, concerns, that's what we'll get to. But first, let's reveal the answer to our trivia question. As a refresher, the question was, digital currencies and tokens are one of the digital assets that play a key role in the Web3 ecosystem. What was the world's earliest known attempt at creating a digital currency? And the answer is DigiCash is often credited as the world's first digital currency, dating back to the late 1980s. DigiCash was a form of electronic money which encrypted information passed between parties during an electronic exchange. However, it didn't quite catch on at the time, and DigiCash, the company, went bankrupt in 1998.
So projects like DigiCash, Hashcash, and others were trying to build this transaction layer for the internet. But the thing that they couldn't solve for was the double spend problem, which is what I described earlier. Basically, how do you ensure that when you move something of value from one person to another, that you can't send the same thing twice, right? So if I want to send an email to one person, it's okay that I can send it to someone else. But if I'm sending someone a dollar, it's important that the receiver knows I can't send the same dollar to another person. And the only way that you can solve for the double spend problem is through the use of a blockchain. So those were great concepts. They were brilliant ideas, but they were missing one critical piece, which is a distributed ledger of transactions that everyone can see and a mechanism to update that ledger in a way that everyone can trust, right? And that is the key innovation that prevented those from succeeding, but that Bitcoin and other Web3 assets have solved for. And I think that's important to point out. Sorry, I didn't mean to interrupt that question.
Okay, Alex, let's jump now to our live Q&A and hear what our audience wants to know more about.